Hey everyone, Chris Johnson with Monday Morning here with 3 stocks to watch for a Tuesday afternoon. It is June 4th, 2024. And not only do I have 3 stocks, but I've got to look at the market from 10,000 foot up because there's something going on that you need to be aware of. And it goes from the top of the market all the way down to one of the stocks we're going to hit today. So just to give you a little bit of a hint, the 3 stocks we're going to hit: Exxon Mobile. We're also going to do NVIDIA because what would it be if we didn't cover NVIDIA on every single day? And then the third is going to be Tesla. Something happening here that you're going to have fun watching. A little bit of chess on behalf of Elon Musk ahead of that shareholder vote on the 13th about that big paycheck that he wants to get. But before I get into that, let's look from 10,000 foot today because something interesting happened. We've all been waiting for interest rates to move lower, but things have to slow down with the economy in order for the Fed to feel comfortable with lowering rates, right? They've been spending the last year plus trying to slow the economy down. Well, this morning, the JOLTS report came in, and it's related to the jobs report that we'll see on Friday from the Bureau of Labor Statistics, the BLS. But the JOLTS report is a report that comes out and tells us how many job openings there are. So availability of jobs in the workforce. This number has been high for a long time, but for the first time since 2021, it's at its lowest point. So just after the pandemic, that's a sign that there are fewer jobs out there for you and I. That's something that the Fed has wanted. Remember, their mandate is they want to be out there and they want to be controlling prices, inflation, and they want to have some sort of handle on what's going on in the job market, right? That's their job. So they're going to be happy to see this JOLTS report come down, but the rest of the market is not so sure. Remember, we've been looking for this soft landing for a long time. It's kind of that panacea or that wish that we've got right now as investors and as consumers, right? We don't want to go into a recession. It means fewer jobs. It means that everything slows down. Our house prices go down. And the Fed's been doing an amazing job at guiding us towards a soft landing. But this JOLTS report is part of the pain that we could endure if we go into a recession. And right now, you're starting to hear a lot of analysts start talking about a recession instead of a soft landing. And it's all because of you and I. Consumer spending is slowing down because we're seeing fewer jobs out there. And that consumer spending, remember, is 72% of the economic drive, the GDP out there. So if we slow down too quickly, and you're going to see some companies coming out, Thor Industries and Winnebago, some of these real discretionary companies over the next few weeks that are going to give you an idea of exactly how much you and I have pulled back on the purse strings here. And that is what's going to start to slow things down. So the market's reaction to the JOLTS report today, a little mixed with the Dow Jones trading higher, the S&P 500, and the NASDAQ composite closing lower. But there's an area in the market that you can start to look at that forecasts where stocks may be heading. And it has to do with commodities and interest rates and all of that. And we're not going to get into the Rubik's Cube of how the market is dependent on all these things. But when we start to look at one area of the economy that really has a big reaction to how we're doing from a recessionary mode or from a spending mode, demand, let's call it, how much we're going to grow, you don't have to go much further than energy and oil, right? We're all upset about higher oil prices over the last couple of years. Well, guess what? That's part of having an economy that is going through the roof. You've got demand for energy. Well, look at what's happened with oil here. This is the USO. It is an ETF that you can buy that goes along with crude oil prices, mimics them, let's say, acts very closely with them. And in this particular case, you can see that this has fallen off of the shelf here over the last couple of days. And not only that, but we had a rollover in oil prices. Now, some of the geopolitical concerns around the world have kind of died down a little bit. We're hearing about the possibility of at least a ceasefire between Israel and Palestine right now and what's going on in Gaza. And obviously, the Ukraine and Russia is going to have some effect here. But this slow roll that we're seeing in oil is something similar to what we saw back in 2001. If we look back at the chart of oil and what's happened here, and I'll just change this to a monthly chart so you can see the longer view here. You've got 2021 coming into 2022. And note that even though oil prices had that help of inflation keeping them higher, inflation drives those prices up. Eventually, we still rolled over in 2022 And that is when we had that bear market that just gripped every sector of the economy. So right now, as I look at this price drop in oil, and we've dropped below all three of those key trend lines, the 50, the 20, and the 200-day, the longest mover there is the 200-day moving average. It's telling us that we're going to see lowering oil prices. It's good for you and I because it means that we're going to see lower prices at the pump here shortly during the summer driving season. But this is also one of those telltale indicators that you want to watch when it comes to the economy. Commodity prices are hitched up with the economy and demand. So right now, the JOLTS report coming out this morning showing fewer jobs. We're going to assume that the jobs report this week on Friday is going to show the same thing, and that's what we saw last month, as it was disappointing. And note that the market didn't hate that data because, again, it all comes back to interest rates and what we want. But watch what you wish for, because if we get those interest rates coming up too quickly, or down too quickly, it's bad for stocks because it means that the Fed is reacting to an economy that is now slowing much faster than they want. It's a delicate balance. So with oil prices starting to roll over, I told you that I'd take that and get us into the stocks that I'm starting to look at. You have to look at energy stocks. Everybody's hot on energy. It's one of the more crowded areas of the market. And this is the XLE. It is the Energy Sector Select Fund, or SPDR Select Fund. So it tracks those companies like Halliburton, Exxon Mobile, which we're going to hit in just a second here. I'm going to throw in a bonus at the end. Somebody asked me in the comments that I did on the three stocks that included Salesforce last week to hit Salesforce and whether you should be holding now. Full disclosure, I am a holder long-term of that company. We'll hit that towards the end. But let's get our way towards energy companies. Notice that the trend here is going right along with what we've seen in the USO, that oil price ETF, right? Haven't taken out that 200-day moving average, but you're seeing volume start to come up here. It's telling you that the selling pressure is starting to increase. And right here, we talk about a death cross, and that's when the 50-day moving average of anything, doesn't matter whether it's an ETF, an individual stock, the S&P 500, whenever those cross that 50 and that 200-day, it tells you that momentum is gone negative from a long-term perspective. Well, this cross, and I call it a flesh wound cross just because I'm a Monty Python fan, but that 20 moving below the 50-day, some people look at the 10 and the 30 for something that's a little faster, but this tells you that that momentum over the next 4 to 6 weeks has gone decidedly negative on energy stocks, and we've crossed below that 50-day, and that 50-day is now starting to roll over as well. That gives you a 4 to 6 week outlook that turns negative. This is a bonus for you as we're covering energy. Energy stocks now start to turn into a target for the sellers that have been holding on to this forever. This has been one of the more popular trades out there on Wall Street, and now you're seeing as it comes off of those all-time highs way up here, right around that $100 level, you're slipping down to 90. What you're going to see next is some of the analysts start to come out and talk about how we'll see less demand for oil if we are heading into a slowdown for the economy. That's where it all comes back to that JOLTS report. So from a daily basis, if you're looking for ETFs to kind of watch here over the next 4 to 6 weeks or so, definitely the XLE is up there on your list, which brings me down to the first stock of the day. This is Exxon Mobile. One of the underperformers right now in the S&P 500 when you start to look at the performance of Exxon Mobile. The stock is down more than 2% today. Looked at the options activity, you're starting to see puts starting to trade a little more heavily than calls here, which is not the norm for Exxon Mobile. This, again, has been one of the more crowded trades out there. When you look at the analysts' expectations or their ratings on the stock, it's still overwhelmingly a buy on Wall Street. Crowded trade, just so you know, in case you didn't know, is when everybody's in. I mean, it makes sense. It's almost like the crowded theater, right? When somebody yells fire in the crowded theater, or when they yell sell in the crowded trade, that's when you start to see volume increase and selling pressure come onto the stock. Just like we saw in the XLE shares, XOM, Exxon Mobile, has going and doing a longer rollover. Why is it a little longer? Well, there are more companies. The nice thing about the XLE and any of the ETFs is you get away from the headline pressure. Now, there are a lot of smaller companies that are in the XLE that have been going down much faster than Exxon Mobile. Nonetheless, this is the big name in the group. Note that you've got that crossover, the 20 and the 50-day, a clear line that's going to take us down to that 200-day moving average, which is sitting right down here right above that 105. Let's call it 107 or so. At that point, a break below the 200-day moving average starts to take it towards a target that's going to be easy for you to associate. That is at the $100 price level. It gives you around 14 to 15% downside on this trade right now. And this will be a mover after the employment report on Friday, as well as some of the data that we've got coming up through the rest of the week. A lot of manufacturing data that's hitting. This is a big week for reporting on the economic side of the market. So Exxon Mobile, your first right now, sitting there up there at that 112, 113 or so with the target of $100. Second one that we wanted to hit, and this will be before we get to the bonus round with CRM, is let's go with NVIDIA second. I think it's rarely a day that can pass when we're not talking about NVIDIA. And if you didn't catch it, 2 weeks ago, I did a video on NVIDIA and how it was the most dangerous stock in the market right now. And I'm sticking by that exact claim here. And this is why. NVIDIA for the last couple of days has been the last stock standing when you start to look at the NASDAQ 100. We look at Microsoft, and I'll just pull up a few of them here, trading well off of its highs. You look at Amazon, again, trading well off of its highs. You look at Google or Alphabet, trading off of its highs. Look at Meta, and it's the same thing. So let me give you a quick lesson here. Back in 2021, the Magnificent Seven, as they became known, were the safe haven in the market. Those were the stocks that everybody started going to whenever they felt like the market was getting a little wobbly. We heard about transitory inflation and all these terms, but nonetheless, we found a lot of power, a lot of strength, and a lot of safety in the Magnificent Seven. That Pavlovian response is still in place right now on these stocks, and it's no stronger on any of them than it is with NVIDIA. For good reason. NVIDIA, and when I come out and say it's the most dangerous stock, it's not because it's the stock that I think is going to go to zero. It's not going to get cut in half. They are lined up for a stock split coming up here, but none of that. This company is going to be around and a leader in its group, but at some point, even the strongest stock in the group needs a healthy break, and that's where NVIDIA is right now. 2 quarters of blockbuster results. And if you missed it on Monday, the company came out right after AMD. It was a little bit of chess, but right after AMD made their announcement about the new chips that they're bringing to market and how they're going to compete with NVIDIA, something Intel did this morning as well. NVIDIA came right out with another flurry of headlines and basically made everybody forget about AMD and now Intel today. Right after Intel's announcement early this morning, NVIDIA was all over the tape. This is the most loved stock in the market. Period. End of sentence. When you look at the analyst recommendations on the stock, you've got almost 100% of the analysts right now recommending this as a buy. This is the same situation I've seen over and over and over again, whether it was Apple, whether it was Intel in 1998, 1999, Apple in 2000s, and you got Microsoft obviously as well. Whenever a stock has that title, the most loved on Wall Street, there's a danger because it's the most crowded. All that we have to do is see a little bit of a pullback and all of a sudden the profit taking begins. Profit taking is healthy on Wall Street. You need to exercise that profit taking muscle every once in a while. The problem is with NVIDIA right now is when traders and investors do exactly that, it's going to cause a ripple effect through the rest of the market. And there are many more profits to be taken in NVIDIA. That's why it's the most dangerous stock. I'm going to give you one price that you're going to want to watch here on NVIDIA, and this is a trigger price for the rest of the market, and that is right up there at that round number 1,100. A lot of people are kind of balancing out the buying and selling right now. You can see volume is starting to drop on NVIDIA. We're also in an overbought reading of its RSI. That's a simple measure that tells you whether stocks have gone too far, stretched the rubber band too far, and it's ready to snap back. whether it's up or down. We'll see an example of down with Salesforce in just a second. Nonetheless, that $1,100 is going to act as a round number trigger. And eventually, when we cross below that, you're going to see 1,000 come in. That is the site of the stock's 20-day moving average. That's where you're going to want to watch for short-term support to come in. If we don't hit that short-term support at the 20-day moving average, the market has been talking about NVIDIA at $900 for the last 2 or 3 months here. It's a price that's going to seem normal if we retrace to it, and that's also where the 50-day moving average for NVIDIA is. That's where you're going to see support start to kick in, and some of the longer-term buyers buy the dip on this stock. So $900 right now is a target that you watch for a pullback. $1,100, could $1,200 or $1,300 happen? Absolutely, but you're going to need some market tailwinds to start blowing, and the headwinds are starting to hit this market. So watch that $1,100 when we close. 1 or 2 closes below that, believe you're going to see $1,000 and then followed by a $900 print. And that's where the true test is going to lie for NVIDIA. Everything else between those two prices right now is just a little bit of child's play. That's where the technical strengths are. You got to watch this stock. With that, let's move on to the last stock, and then we'll hit real quickly an update on Salesforce for the person that put the question in the comments. By the way, put your questions in the comments. What stock do you want to see me hit next? Somebody asked for Carvana. Maybe I'll slip that in. It's a great consumer discretionary company to talk about. But Tesla is your consumer discretionary stock for the day, and I talk about Tesla quite a bit. It is in a situation that we've only seen 3 times in the last 4 years or so. And I'll show you that situation in just a second. And it means that Tesla is going to move 10, 15, maybe even 20% here over the next couple of weeks. And it's got a perfect trigger with the June 13 shareholder vote. If you're unaware, June 13, it's shareholder day for Tesla. But this one's a little special because $56 million is on the table for Elon Musk. This is that pay package that was denied by a judge in Delaware. It's the reason that they're moving the company to Austin, Texas for their headquarters, because he's upset with having to deal with Delaware judges. But let's put all that aside and look at what he did today. Elon Musk came out this morning and pulled not a fast one, but certainly a chess play when everybody else may be playing checkers. Headlines came out on CNBC around 10 o'clock this morning that Elon Musk had been in contact with NVIDIA and has moved the delivery of thousands of NVIDIA chips, their GPUs, from Tesla to X and XAI. So X being the company that Elon Musk owns himself, obviously XAI in a similar situation. Tesla being the company that would be using those chips to build out the autonomous vehicles and such, using the AI technology to build that Tesla brand. A lot of people might look at that and say, big deal, he's moving it from one thing that he owns to another. Well, remember, Tesla's a publicly held company, and X is not right now. A couple weeks back, Elon Musk made a comment that perhaps if they didn't approve this package, he should take his talents elsewhere. He wasn't going to be able to see his creative dream unfold at Tesla. It's kind of like LeBron James when he decided that he was going to take his talents to South Beach, right? Remember those days? We had Cleveland Cavalier tickets back then when he left. Cried maybe for a couple of minutes. But nonetheless, that's exactly the situation that's being pulled off here. Elon Musk with his headlines today about taking those chips over to X and XAI, kind of giving a little bit of a, hey, maybe I'm really going to follow through with that, and Tesla's not going to have me running things. That puts Tesla shareholders a little bit on edge because he has been the visionary, obviously, of what's been built into the largest EV manufacturer in the world. Right now, that name has been a little bit at stake here. The technicals are showing you that there's a concern. This weekend, we saw ISS come out, and they are Institutional Shareholder Services. That's a company that will come out and tell you whether or not they recommend that you vote one way or another on a proxy vote. They recommended that shareholders vote against that pay package and thought that there should be something in between $0 and $56 billion for Elon Musk, which makes sense. Let's negotiate this thing a little bit. Nonetheless, the stock has done something it hasn't done it's about 1.5 years now, and that is that it has absolutely gone quiet. Notice this straight line you can almost draw through Tesla's price, and it's right there at that $175. Now, I don't talk about Bollinger Bands too often, but this is a key. This is the smallest reading of those Bollinger Bands in the last year. So in other words, a Bollinger Band will measure how volatile a stock is. It tells you how much it's moving. The more a stock moves, the wider it gets. The less it moves, the tighter it gets. The thing is about volatility, when it gets very tight like this, it more or less tells you that you're going to have a widening of those bands. And how does that happen? The stock gets volatile. Last time this happened, the stock moved 23% lower in about 8 days' time. Before that, it moved up by 11% in, I believe it was 13 days. And then the time before that, you saw the stock drop 30%, and that happened over an 18-day period. So volatility is on the horizon. June 13th is a date it's likely to happen unless we see a headline before then. How do you position on this? A lot of people will say, hey, CJ, do I buy a straddle? I think straddles are a little bit of a waste of money in this particular case. If you're asking yourself that question, you just wait until the announcement happens. But know that 200-day moving average is above hand. And let's go beyond the vote here. Discretionary stocks have been in a lull, and they're going to continue. If you look at the XLY, which is the discretionary stock ETF, that right now is showing you a familiar pattern, a little bit of a long-term list lower. Instead of going from the bottom left to the top right, you're going from the middle of the chart towards the bottom right of the chart, and that's not what you want to see right now. Companies like Ford, GM, everybody's suffering right now. High interest rates, high expenses mean that we're going to spend less on discretionaries. Even Airbnb, which is in this index, is pulling back. So back to that Tesla chart, you expect discretionary pressure to put more pressure overhead on Tesla. A break back below that 50-day moving average for Tesla is also going to get the sellers coming in. Notice how your volume has also dropped here. I think before that June 13th, we see this start to break into its volatility move as everybody figures out what's going to happen with that vote. And it looks like it probably, if you just took a straw poll today, would probably not pass. And that's going to result in the stock moving back down towards that 160. The danger there is that when you look at the monthly chart here of Tesla, you're already trading in a bear market. That's that 20-month moving average. We're trading below it. At $150, we start to take out the lows that we saw in January 2023. So not even 18 months ago, a lot of people feel like $100 would be a huge bargain. We were at this price 18 months ago. At that point, you have to start talking about $75 being the target, or maybe $100 in between. $100 round number is always going to provide some support. And that's where we saw, again, that stock trade right there in January of 2023. So the outlook on Tesla right now, based on what's going to happen with that vote, is going to be very important. Nonetheless, I look at the stock from the perspective of this is going to explode. If you're wanting to look for an opportunity to buy it lower, right now the risk reward is on the risk side for Tesla because of its trend lines. So expect to get it for $160 to $150. A break below that 150 is going to give you an opportunity to buy it at 100. Remember, they're going to have an earnings report that's going to be coming up in the next month and a half or so, and they did not have that kitchen sink quarter, last quarter that we thought they might have, that would really cleared out the baffles and allowed Tesla to maybe start moving forward. But pressure from China as well as other forces, our pocketbooks, are working against the stock and the consumer discretionaries. So that's your three stocks of the day. Exxon Mobile, watch it now as we start to see it breaking down lower with the oil demand for oil. When I look at right now, NVIDIA, that 1100 mark on NVIDIA is the mark to watch, and that is a trigger for the rest of the market. If we see NVIDIA break below 1100, you're going to see wider spread selling across the market, especially the NASDAQ. And keep in mind those magnificent six, which is really about a magnificent four at this time with Tesla being out, is going to start dropping very quickly as well. And then you've got Tesla right at this 175 level. Watch for volatility to storm to hit the stock. I did get asked about Salesforce.com, and I want to hit that very quickly as I close it down. Last week, I nailed it on this. Down around that $220 mark, we saw some buyers start to come into the market in what we call a dead cat bounce. There's your 20% drop, 23% from earnings. Stock is naturally going to start to bounce off that oversold reading that we saw. Now you've got the true test that's going to happen as we hit down towards $220 price tag on Salesforce.com. Do you hold it or sell it? That's, of course, a decision you have to make. As a long-term holder myself, I'm dollar cost averaging into the stock. Expect to be able to buy more shares around $200. And if I have to, down around $175, again, lowering my average cost. I take the same approach with Dell, which is another stock I'm sure somebody's going to ask about at $130 here, but we'll talk about that one next time. As I said, leave a stock in the comments below if you want to see me hit it. It's part of the 3 stocks. Always looking for what's moving each day and what we can comment on to help you figure out where the trades are in this market. Until the next time, Chris Johnson wishing you the best trading success. Don't forget to check out moneymorning.com for my commentaries on the market. We'll have a new one up there tomorrow that will include what's going on with the economy from 10,000 feet in a couple of sectors. And like and subscribe to the channel so you get more content like this. Have a great day.